Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We're going to dive into the economic data right now. We've given Tiffany Wild over at PIMCO, Newport Beach, California, time to do it. But Tiffany, I got to rip up the script right now. The new CEO at Starbucks is going to stay in Newport Beach instead of commute to Seattle.
Smart person.
I mean, Tiffany, what is the attraction, the allure of Newport Beach versus him and the fam moving up to Seattle?
Well, I think it's your favorite restaurant, Malarkey's, by Fashion Island. But to be fair, the beaches here are very gorgeous. It's like living in a resort community. It's very different than New York City. It's a very nice place to live for sure. I'm not surprised.
You're killing me. Let's migrate to retail sales right now. It's just such a tough life for Tiffany. Wow. I got a nominal number here. Important, Tiffany, is I got some revisions that are actually pretty quiescent. This is a constructive set of data, isn't it?
Yeah, I mean, I think the bottom line is, just looking through this, is this completely confirms that the U.S. was not in recession in July. And obviously the risks of that, or at least the market's focus on the risks of that, were increased because of the unemployment report, and specifically the increase in the unemployment rate, which has triggered the so-called SOM rule. Historically, the SOM rule has been a good indicator that we are in recession right now. But as we've been discussing, there's good reasons to believe why this time is actually different with that rule. We've had pretty big supply side gains in the labor market over the last few years as a result of immigration and just folks coming back post-pandemic. And that's not the markings of an economy that's in recession. This retail sales report just completely confirmed that.
So on the retail sales, Tiffany, again, I'm going to look at the control group. I'm not sure what's all excluded, but let's go with it. The control group, positive 0.3%. The consensus was 0.1%. What do you make of the U.S. consumer these days?
Yeah, I mean, I think overall the consumer is still strong. I do think that you have seen some deceleration in consumption, but that's okay. We were living in an economy where you had a lot of above trend growth. Some of that was due to immigration, but some of that was due to just the fact that we had a lot of stimulus post-pandemic. As that is wearing off, you're seeing things just normalize. So I would argue it's just a healthier environment for consumers. You're seeing them more picky, with pricing. Obviously, we had the Amazon Prime Day and related promotions that probably boosted nominal retail sales in July. But overall, I would say that we're getting back to normal for the consumer. Okay.
My problem is, Tiffany, and it was the number one fight I had with the wonderful Alan Meltzer at Carnegie Mellon. The average Newport Beach, California home price is $3.393 million. That's the average price off Zillow for the Tiffany Wild hood, $3.93 million. Tiffany, that's not America. How much of the buoyancy in retail sales is coming from 10% of the public?
Yeah, no, you're absolutely right on the distribution of outcomes given wealth level, and we very clearly see that in the data. So when we look at the retail sales number, that's the average consumer, and that hides a lot of differentiation under the surface. And you're absolutely right. What we're seeing is that lower income consumers, they are struggling. We are seeing more delinquencies on credit cards, on auto loans, and things like that. But overall, the consumer is doing quite well. The consumer, in terms of its balance sheet, we came out of this recession, the pandemic-related recession, with actually consumer balance sheets being stronger than where they were when we came in. That's something that never happens in a recession. Consumers are also enjoying a lot of wealth that's been created in the largest asset that they have, their homes, as a result of home prices increasing. And a lot of them also have low mortgage rates still. So, I would say, yes, there is some differences, by income level, but overall, the consumer is doing quite well.
All right, the consumer's doing quite well in general. We've got, I guess, inflation coming down, moderating as we continue to see that in both the PPI and the CPI data. So what does that set up the Fed to do in September, do you believe, Tiffany?
Yeah, I think there's, when you have an economy that's getting back to normal, you need to have monetary policy that's also getting back to normal. And I think Fed officials would argue that they think policies in restrictive territory. We would agree with them. We do think higher interest rates are restricting the economy to some degree, and just bringing that back to normal also makes sense. And we think that's what they're going to start to do in September. And they're probably going to do that. They could do it at varying degrees. The market's obviously pricing in some chance they cut rates by 50 basis points.
Right.
We think 25 is more likely, just because the economy is not going into recession. So they can kind of do this in a measured, paced way, and get the economy back to normal.
And Tiffany, if you're sitting with the animals like Jerome Schneider, and they're just snarling and they're angry, it's miserable out there at PIMCO. Tiffany, you're talking to Jerome Schneider, and he goes, what's your GDP call? Quickly here, what's your real GDP call up 12 months?
Yeah, so we're still looking for an economy that's doing quite well. Maybe not as well as last year when it clocked 3% growth, but our forecast for this year is around 2%, and a little bit below that, in 2025.
Okay, so it's grim, 2.2%. What portion of America is living Lawrence Summers stagflation beneath 2%, or even feeling a recession when you're aggregating at 2.x% real GDP?
Well, I think that, the thing to remember is that, looking back at the labor market statistics, the unemployment rate has been going up, not because people have been losing jobs. On aggregate, we've actually had job growth over the time period that we've seen the unemployment rate rise. So you're seeing people that are coming back to the labor market, and folks that have entered the country entering the labor market, and the folks that have jobs are keeping them. So that's not really the markings of an economy that is stressed.
Tiffany, thank you. This is the interview of the day. From Newport Beach, California, she's 1,000 miles from where she wants to be. Tiffany Wilding of PIMCO. Greatly appreciated today in retail sales. Dana Telsey joins us right now. And for Lisa Mateo and Tom Keene, who have children in Ulta Beauty, why? Dana Telsey, you have an outperform on Ulta Beauty. Warren Buffett listened to you. Why is Ulta Beauty the future of my paycheck going out the door?
Because first of all, thank you for having me, Tom. Great to hear and see you. I think, first of all, when you think about Ulta Beauty in the beauty category, it basically appeals to so many different ages. You look at the categories within it, whether it's skincare, whether it's makeup, whether it's hair care, a lot of innovation. You see that your daughters, they're basically being attracted by all the new initiatives, all the new brands that are out there. There's a sustainable, clean emphasis on it also. And people have fun with beauty, especially today, given that we live more in a Zoom society than we did pre-pandemic. So whether you're seeing people in person, whether you're seeing them on Zoom, Ulta Beauty gives the opportunity to look good with all different brands and all different categories.
I'm glad we have hair routines you'll love, their best back-to-school hairstyle. Great. What are they doing? Why are they distinctive versus Sephora to Mr. Buffett?
A couple things. First of all, the stocks come down a lot. It used to be trading at around 40 times. Now it's trading below 20 times. You think about their customer base. They offer from mass to prestige, so a wide income span. They have hair salons, so people go there for services too. When you go for a service, there's an attachment sale that rings up with it. When you look at their locations, they have very close destinations, and a lot of them are outside of the mall, so they're convenient. And now with a new 5,000 square foot box that they're testing, there's even potential to go into some smaller areas. So you've got breadth of categories, you've got closeness and convenience, and you have mass to prestige. And with that, you have the grandmother, the mom, and the daughter.
Hey, Dana, I'm looking at Walmart here. They reported numbers here this morning, beating estimates. They raised their sale guidance for the full year. The stock's up 9% pre-market. What did you take away from our friends in Bentonville?
I thought overall, excellent execution. And look what they're doing. They're gaining share. If they can say they've gotten a bigger share of the wealthier consumer and they haven't seen any weakness in some of their core customers, what does that mean to me? The dollars that the consumer has, they're allocating to Walmart, and their more effectiveness in their category offering, in their price offering, and the meaning of value, they're a share gainer.
Dana, I want to talk about luxury here because there's a lot of negative talk about it. And there's other things doing well, different companies, selective. But I'm witnessing a name I didn't even know, Roger Vivier. Basically, folks, I'm going to editorialize, is on fire. They've got a thing with Laura Dern they're doing with her daughter, and their internet exposure of shoes nobody can afford is like unbelievable. Really? Dana, give us one vignette about how a brand like Roger Vivier gets a moonshot in the summer of 2024.
Man.
I think what you said, a little bit of collaborations of who's wearing it like Laura Dern. Check out their store on Madison Avenue, which they recently reopened, renovated, and you have a very iconic offering in terms of what their shoes are, and certainly the emblem that's attached to it, and they've modernized it. This is an example of intentional buying of brands is driving demand. And you have intention there, it's an iconic offering, and it's back in vogue again.
How can our listeners and viewers profit from things like Roger Vivier?
I think overall, when you think about some of the luxury brands, you take a look today, Tapestry's results were very, very good. High gross margin, new customers are transacting at a higher average unit retail selling price. So when you think of brands that they say what they do what they say, and they stand for something, I think you have, whether it's LVMH, I don't think that while their sales growth may have slowed, the brands and how they innovate and create demand, it's something that's so unusual and compelling.
Dana is such a retail animal. Did you hear what she just said? Mm-hmm. She said customers are transacting. That's Dana Telsey talk for spending money, just to clear that.
And Dana, I have no idea how Tom Keene knows about Roger Vivier shoes, but the Viv Skate Metal Bucket sneakers in soft leather and white, retail $1,075.
No way.
Yes, there you go. Sneakers $1,000. There you go. So talk to us about, Dana, about in the luxury category, where's China? Where are the Chinese consumers these days?
Slowing down. The Chinese consumers are slowing down. They're spending within China. They're not traveling as much as they had. A lot of them are buying some local Chinese brands, and companies are having to work harder with their marketing dollars in order to win business from the Chinese customer. And you've seen it among many different brands out there. There's still opportunity going forward in China. And I think the specific marketing to that core consumer within China is really what's going to win the day. And we're seeing companies refocus on that.
Are companies still, I mean, again, China's a huge market. It's been a huge driver of the luxury space. How do luxury companies, how do they operate in China? Are they still investing in China? Because a lot of industries away from retail are really concerned about that.
They are concerned about it, but yes, they are still investing. The ability to have a physical footprint basically provides the brand awareness. Have goods that are exclusive to China is key, because when these Chinese are traveling outside of China, they have to know that they're getting exactly what it looks like in China and its authenticity. So being able to show what that brand aesthetic means is key for getting them to transact in other places when they travel.
Dana, the Telsey Advisory Group thoughts on Walmart, its future out 5 years.
Stronger and bigger. and being able to capture a wider consumer base, the physical footprint will be even more omni-channel than what it is today. And I think the marketplaces area and the whole omni-channel initiatives are going to be made easier. I think the seamless ability of Walmart to capture more households, what you're seeing now with even wealthier consumers buying from Walmart, makes it easier. It's value and convenience. That's the synonym for Walmart.
Dana Telsey, thank you so much. Just brilliant there, particularly.
Always.
I really appreciate the Alta conversation. Lisa and I will commiserate over that. Thank you for the international response to our coverage of the Mars transaction with Kellogg's over their snack foods. We wanted to go out across Wall Street to the eat side, not the sell side or the buy side, but people that actually try the product. Joining us now with her full team coverage of Cheez-Its, Amanda Lynam for Blackrock as well. So jalapeno's the way to go.
Jalapeno Cheez-Its stuff.
You won't get it?
Yeah.
Now, should I go with the duos where that I split it between a jalapeno and the traditional
I don't have a
cheese
strong
Cheez-Its?
view on that, but you do have to try the jalapeno.
Okay, we will
Cheez-It,
try that at our house. Not for me, but jalapenos is very big. I swear, folks, this is our final discussion of Cheez-Its, other than congratulations to the Mars people, the Mars family, $29 billion transaction, $6 billion of debt. Good luck with that. On the bond market, is it showing a new message off the equity panic of 8 days ago? Is there a new tone to your fixed income space at Blackrock?
So actually, and good morning, thank you for having me. The credit market's resilience was probably the big takeaway over the volatility of the past 2 weeks. You saw markets, the volatility index, the VVIX, certain parts of global equity markets set new post-financial crisis records or even pre-financial crisis records. Actually, credit spreads didn't even come close to their median or the average over the post-financial crisis period. So I would say the takeaway is that credit held in better than other asset classes, all things considered. And actually, we saw better buying on the little bit of widening that we did have. And we've, at this point, retraced, depending on the asset class and the rating, around 50 to 75% of the widening that we saw. I think there's a lot of kind of focus on the resilience of credit spreads and kind of why this is happening. Obviously, lots of well-telegraphed reasons for that in terms of sector shifts and the composition of the index rating shifts. But one of the points I think that's actually not discussed enough is that just companies are staying private for longer in this new cycle. And by the time they actually issue into the public markets, they're larger and more diversified. And so that's why credit, we believe, is holding in better.
How much credit risk do you want to take? I mean, I consider it 2-year Treasury, where I'm happy to hang out at 4% here. How much credit risk do I want to take?
We like taking credit risk. I think one of the actual interesting things, and you can see this on the Bloomberg intelligence data actually on the terminal, margins for high yield credit have been improving over the past few quarters, which is a bit of a counterintuitive result.
What does that mean? What is margins for high yield credit?
So margins for your high yield index, you have the LF98 high yield index, LUAC IG index. Actually, in aggregate, the margins for the high yield universe have actually been improving. So in this kind of era of focusing on a higher cost of capital, a slowdown in the economy, you would not expect EBITDA margins.
How many basis points, how many percentage points do you pick up on a high yield Amanda Lynam piece versus full faith and credit or some AAA Microsoft debt?
So the spread, the actual spread on the high yield index is around 338 basis points over treasuries.
Yes, 3.38%.
But actually, when high yield investors are deploying, they're focusing more on the dollar price and the yield. The yield on the high yield index is around 7.55%. So that's a meaningful cushion in terms of when you're actually deploying capital in this credit market, that you're able to earn a pretty attractive all-in yield. In IG, for comparison, that's around 5%. We've seen significant demand for IG at 5.5% yield, so we're slightly below that given the rate move. But in general, I think so long as you expect trend or ideally above trend growth, and we're actually there, we're at above trend now, that's actually a pretty supportive outcome for credit.
See how she spoke English there? It was great.
For these credit people,
we got her off the jargon.
I don't trust them.
I understood that, I think.
Tom, I think if you're a salesman on Wall Street, a credit salesman, and you got a new issue, is the first company you call Blackrock?
Yeah, it used to be Fidelity, but
so-
Larry's been working, so he's called Blackrock.
So you call Blackrock. I mean, what's your interest in new issues? When Wall Street calls you with a new issue, what are the things you look at?
So in general, new issues have been an attractive way to deploy capital because they often come at a discount to the existing debt. We call that a concession. Sometimes those concessions are large. More recently, they've been quite modest, but still, it's an attractive way to deploy capital. The really interesting thing, and we're actually writing about this this week, is that supply in the IG market has outpaced the monthly average every month so far this year, despite the higher rate environment, right? In high yield, it's outpaced most months. So what that tells you is that corporates are not being sidelined by high rates. They're moving forward with what they need to do. The other interesting point, strategic M&A acquisition activity is actually tracking well above the 2022 and 2023 pace, and it's actually only 6% below the 10-year average. So there too, like the news that we've seen recently, corporates are moving forward with strategic plans despite the higher rate environment. But I think the one point on supply that I would make, it does feel like this is a bit of a pull forward towards late in the year. We're running well above what would typically be implied for the summer. So I would expect a slowdown, but we haven't seen it yet.
Okay, fine. But to get to the real world where Mars as a private company takes out jalapeno Cheez-Its, I get that. I mean, forget, Mars has their own way. How do people finance those large transactions? The big money's out there, right?
Yes. So it depends. In aggregate, we've seen cash-only deals represent 52% of the year-to-date volume, which is actually slightly above the longer-term trend. Stock-only deals are actually also above the longer-term trend. So that what's actually narrowed is the mix of cash and equity transactions. It's a little bit misleading to call it cash and debt, though, because for a bondholder, when an acquisition is funded with cash, that can either deplete the excess liquidity on the balance sheet or ultimately it gets replaced with debt. So from the perspective of a bondholder, we care how this is funded.
We're taking CFA level 2.
I know. I'm taking notes over here. I don't know
Everybody in the room is just staring across the Javits Center at Amanda Lynam going, it's not fair. The curve. Amanda, you're going to ruin the curve.
How about private credit? How do you guys think about private credit? I mean, how does that impact your business?
So we actually think about private credit as this third and viable funding option for a wide range of corporates, in addition to the traditional bank lending channel and the public debt markets. That wasn't the case several years ago. That's because private credit has now grown into a sizable and scalable asset class on its own right, so it can compete in areas where it previously could not. We think that kind of ability to coexist peacefully with the public debt markets is here to stay. We expect the mix shift between the two markets to ebb and flow over time, depending on market conditions. Probably the most notable thing that I've seen is that companies with demonstrated access to the public markets, either high yield or loan, are actually choosing in some instances to refi in the private market.
So like a Mars, as Tom was just talking about the Mars transaction, they're going to finance this, they said, with cash on hand and then with new borrowing. So presumably they're going to go to, I think it's JP Morgan and Citi are their bankers on this transaction. They'll see what kind of, I guess, credit terms they get from them. Maybe the public markets as well. They'll hear from their bankers about what they can do in the public markets. Will they also go out and put bids out for private credit, do you think?
So leaving that transaction aside, it is common to see what we call dual track processes, where corporates, CFOs, treasurers evaluate their funding options in both markets, just like anyone would do in terms of, do I issue a high yield bond or a leveraged loan, right? That whole kind of slate of financing opportunities is available. Similar, Tom, to your point on the M&A funding mix, that's a decision that corporates make depending on what is the balance sheet capacity that they have to add debt at the ratings where they're comfortable, where is their stock price. In aggregate, I would say that funding mix for M&A is tracking in a fairly kind of benign way for bondholders, meaning not skewed super strongly to debt, but it does matter a lot under the surface depending on the sector. And as you can imagine, there are certain kind of cash-rich sectors like tech and pharma that are leaning more heavily on cash and debt.
What will Mag 7 do? I find it, from a Zvi Bodhi at Boston University's standpoint, almost immoral that they haven't popped out to 10 or 12% debt.
Well, in general, in the credit market, as you know, that's a much smaller section of the credit market relative to equities. Net leverage is still really low for that sector in aggregate. So I think it's reasonable to assume that when they're adding debt, they're just moving closer to their leverage target as they build that up over time.
Amanda, thank you so much. Amanda Lynam with us at Blackrock, just a clinic there. Take a look at the front page. It's a Lisa Mateo hour. What do you have?
All right, so we just talked about, Starbucks' new CEO not working in, Seattle. Google's ex-CEO, he's talking about the work from home. He's actually blaming it in the company's losing battle in the AI race. So he's saying, Eric Schmidt, he's also the former executive chairman, he said this during a talk at Stanford University. He was responding to a question about Google competing with OpenAI, and he said, Google deciding that work-life balance and going home early, working from home was more important than winning. So that was a shot right there. He also said startup work is important because people work like heck to get those startups going.
That wasn't the correct quote there.
Home. Yeah.
You gave the PG version.
I did give it before. Yeah.
No, but you're right. I mean, Lisa, the startups, he's right on that. You talk to folks that work in the startup business, that's their entire life. It consumes them day and night, and they're just, because it's make or break. You either make it or you go bust. And so they work like crazy.
To close a loop on this, to the Wall Street Journal yesterday, Mr. Schmidt said, quote, I misspoke about Google and their work hours, Schmidt said Wednesday in an email, quote, I regret my error. Wow, the pushback must have been something.
Yep. But he joins a long list of corporate leaders, including JP Morgan Chase CEO Jamie Dimon and Tesla CEO Elon Musk, who have complained about work from home policies, saying they make companies less efficient and less competitive.
What he needs to do out Stanford, Palo Alto, go see Professor Booth. Yeah. Nicholas Booth is really led on this and actually studying the issue. And a lot of tycoons like Eric Schmidt will say, I really don't care or I don't believe. But the answer is, at the minimum, it's a raging debate, Lisa. I see it in the streets of New York. I'm thunderstruck at Lexington and Park Avenue. I know there's a summer slowdown. I get it.
Right. Sure, but it was bustling.
It's more now with work from home. Next, what do you got?
This new study shows Gen Z voters don't want social media restrictions. Shocker here.
What does that mean?
Gen Z voters, they don't, because there's all these talk about regulators trying to cut back and get some tough regulations on these social media apps to protect kids. But these kids, Gen Z, 12 to 27, they're saying they don't want the restrictions. There was a study out, more than 60% new voters oppose requiring kids under 16 to ask for their parents' permission to use social media. The reason why this is important, though, is because Gen Zers, more of them are getting closer to that voting age, so they're starting to have a say in this, and there's such a huge proponent of social media. Most of the Gen Z is the most active people on social media.
Isn't the biggest debate here on August 15th or whatever it is, this whole idea, a lot of schools now are saying leave your cell phone at the door?
Yeah.
To me, this is a lot bigger deal.
Yeah, exactly. I think that's a lot of schools in a lot of states, but actually not a lot of states. I think there's about 8 or 9 states that have had some legislation saying, you got to put your phone here in a secure place. Right. You're not taking it into the classroom.
Right, like my daughter's supposed to.
Yeah.
For dinner. Yes, we do that too. No cell phones at the table.
We line up the phones.
The Mateo household is strict.
It is.
She runs a strict.
Vet bill. All of them. Mrs. Keene, my phone. All of them get lined up.
Okay, good.
And then we all dash for them.
And afterwards.
No, I don't want dessert.
You go for the phone. No, but it's true. A lot of them, like even my daughter's school, you got to keep it in the backpack. But they get these notifications too. Like the kids turn on notifications for social media, so their phone's constantly dinging, when they get like some kind of post or someone responds to them. So it's that distraction. Okay, we've been talking about, grocery stores, a growing grocery bill. Well, grocery stores are now getting selective about their shelf space. We talked about them leaving more space for the store brands because people are switching to the store brands because they're cheaper.
I've done that.
See, you've done it. I've done it too. So you see the grocery aisles starting to change. Now these major food companies, they're fighting for the shelf space, that they once had that major part of it, and now they're fighting for it for the store brands who are getting, some more greater competition there. They're trying new things, they're trying new products, they're trying to work to ensure their packaging prices appeal to shoppers. But the thing is shoppers just want to spend less.
Yesterday, I learned a new term that I had not heard before. Okay. It's called inner store. Jen Bartashes, who covers supermarkets, grocery stores for Bloomberg Intelligence, she just threw out this term, inner store. And I'm like, what's inner store? Yeah. That's the stuff that's like in the core of the supermarket, and that's like the basics, soups and things like that. Okay. The outer rim of the store, the edges of the aisles, the ends of the aisles are the higher margin stuff. and where they tend to have maybe some promotions and things like that. Whereas the basics, the stuff you just have to get every time that you don't need to promote, you don't need to do anything, that's in there. I don't get it.
I'm in the camp that everybody's buying the same 37 products. Try to get a quart or a half gallon of 1% milk. Good luck with that. All sold out. Butter, gone. Everybody wants the same.
It's
an Irish butter. It's Guinness.
There you go. Guinness of butters.
Next. You got one more?
Yes, your favorite topic, breakdancing in the Olympics.
Geez, you're killing me.
So there's actually some controversy around it now because there's a breaker from Australia. Her name is Rachel Gunn, her AKA Ray Gunn. She's from Sydney. She's a Sydney University professor. She did this dance. It was called like the kangaroo dance. She did some other weird moves, but she scored 0 points. And the thing is that a lot of people are making zero. So a lot of people making fun of her. They went to the late night talk shows, but there's actually an online petition that's criticizing her. So now you have the Australian Olympic Committee getting in the middle and saying, hey, leave this one alone. Like we represent, we're behind her. They support her.
Right.
But the question is, will it come back to the Olympics?
How do these things become Olympic sports? How does something get approved to be an Olympic sport?
A lot of politics.
I guess.
I
don't know. Did Rich Truman agree to say breakdancing?
Yeah.
I don't get how you have breakdancing, but you don't have like softball or baseball.
Yes, good point.
Could you imagine Lisa's hair in glam rock?
Yes, totally.
Like Lisa's out on Long Island, Joan Jett's playing. It's Thursday night. She's got the 5-inch platform, the Kiss shoes on, the glam rock hair. We did boy bands yesterday. The emails were so kind. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.